let's talk about digital advertising and specifically some stocks that you might be interested in as a potential investment. Hashtag not personalized financial advice, of course, but as a potential investment. A lot of folks come to me and they say, Kevin, what do you think about Disney? What do you think about Netflix? And one of the concerns that I have is both Netflix and Disney have an extremely expensive CapEx structure for creating new content. They spend a lot of money on building studios and producing content. And their goal is that they can subsidize some of that content with advertising. However, according to Netflix's own earnings call, they're not seeing the kind of adoption for ad-supported Netflix streaming as they had hoped. And this, in my opinion, makes me much more interested in, rather than potentially investing in the quote-unquote gold of digital streaming, it makes me much more interested in actually investing in advertising companies that might be benefiting regardless of whether we're heading into a recession or we're heading into this sort of uncertain future for how we're going to monetize digital streaming. After all, we know a lot of companies have told us we are running into a lot of potential risk when it comes to advertising. American Express in their earnings call told us that businesses are spending less money on advertising. Google told us that advertising demand is flat to negative. For YouTube, it's straight up in negative for the last 2 years. When you look at Meta, you have warnings on advertising. When you look at Amazon, you have warnings on advertising. Advertising across the board seems to be a risky venture right now. And it makes sense. I mean, we could look at some reports to see just that. Ad budgets, here's a report that suggests ad budgets are set to slow even more in 2023. I believe this was a Forbes report here. Lower ad budgets in 2022 affected nearly every ad stock, including companies like Alphabet and Meta. And what's happening here in this next year going forward? Well, look at some of the ad spending. First, China, according to Insider Intelligence, will weigh heavily on the 2023 numbers as the second biggest digital ad market is expected to, quote, post its lowest digital ad growth on record due to tougher regulations and economic headwinds. The U.S. advertising market is expected to grow by about 5.9% in aggregate in 2023, and that's lower than the 9% we saw in 2022. However, look at this. On a brighter note, the article says, the connected TV market is expected to grow 14.4% in 2023 and will grow faster than the overall advertising market. Linear TV, in exchange, is expected to fall by 6.3%. And 2023, according to this individual from, this person might be a little biased. He's a director of programming CTV supply at Xandr. 2023 marks the new age of CTV. Yeah, whatever, okay. That's way too biased for me to really even have read that. But anyway, the point is, we know that the ad sector is slowing growth substantially. We know that expenses at Disney and Netflix are through the roof for investments into advertising. So potentially, where does it make sense to invest? Well, ARK Invest is a big fan of investing in Roku. I personally have some qualms about investing in Roku, and I'll show you specifically why. So first of all, this is the last earnings statement from Roku. And what you could see is that, first of all, they're massively negative on their devices revenue. We know that. They don't actually make money from their devices. That's fine. But what we do notice is that you actually have seen margins at Roku compress 500 basis points year over year for the fourth quarter. And so now it's sort of like, dang, like where do you invest in the advertising sector, right? It's tough. You've actually grown platform advertising revenue by 4% at Roku. Now that's great, fantastic. Revenue has grown by 4% at Roku, but for a company that's losing money, that's potentially not the greatest thing that we want to be hearing, that revenue's only growing at 4% at Roku. It's trading like a growth stock, yet it's not really growing that much. It's growing by about 4%. Not only is it growing by about 4% year over year here, but you're seeing that margin compression and an explosion in sales and marketing. If you look at the sales and marketing line, you'll see $297 million spent on sales and marketing. 297 is an explosion of 82%. They spend 82% more money on sales and marketing to grow revenues by 4%. That's insane. According to Bloomberg, revenues for Roku are expected to remain negative through 2026. So you have an infinite PE ratio for this company. Not only that, if we look at their current assets, you're sitting decently at cash and cash equivalents of about $2 billion. They've got about 1.1 in current liabilities. So you've got maybe about $800 million of rough free cash. But the problem is, for the year ended 2022, this company had negative free cash flow. Roku had negative free cash flow of $172 million. So yeah, you've got a little bit of a run rate, right? You've got maybe 3-4 years at this burn rate of negative free cash flow. You've got the extra cash there at Roku, but you're paying a pretty high valuation for a company that's not growing well at all. 4% increase in top line revenue while spending 82% more on sales and marketing, kind of wild in my opinion. Now that's just looking straight at the shareholder letter. You could also look at some other sources and see basically the same thing being said, but a little bit differently. Here, for example, and I know some people don't like it, but this is why I like going to the sources myself. But here, for example, is Motley Fool and their opinion. And they usually are bullish, it seems, on a lot of things, but not on Roku. Look at what they had to say. Roku's audience is still expanding, but its margins are crumbling. Its gross margins, that's different from the margins that I talked about because I specifically talked about streaming margins where you get a 500 basis point fall year over year. This is their gross margins combined falling about 190 to over 40 to 42% in the fourth quarter. We're looking at, again, slightly different margins here. The gross margin of its platform business, which generates most of its revenues from the integrated ads on Roku, fell from 60.6% to 55.8% thanks to macro. And then, of course, their set-top boxes margins also fell. And so this sort of begs the question, where is Kevin liking the advertising business? Well, many of you already know this, and maybe you've already said it out loud. To me, it's obvious. It's Trade Desk. I've personally been a big fan of investing in Trade Desk. This is their Q3 report. Let me grab their Q4 report, which is right here, and take a look at why I like Trade Desk. So Trade Desk grew its sales and marketing expenses by 28%. So Trade Desk grew sales and marketing by 28% year over year, and their year over year growth was 24%. So rather than growing revenue 4% at Roku and spending 80-something% more on marketing, they grew revenues 24% year over year while only spending 28% more on sales marketing. They also had that drop off on stock-based comp for their G&A, so you had a larger net income this quarter, but you actually have growth. Now that growth is slowing, don't get me wrong, it is a slowing sector, right? You had growth that slowed from 31.8% year over year to in the last quarter just 24% growth. So growth is slowing. It is that recessionary pain that you are seeing, but you actually have a cash flowing business. Not only is it cash flowing, but the company is performing substantial buybacks because they've got plenty of money to cover their payables. And any of the extra cash that they have, along with their free cash flow of $475 million for last year, they are performing stock buybacks, which is great. So here's a company, in my opinion, that if you're looking for something in the advertising space that is basically connected TV advertising, Trade Desk is the one that has all the pricing power. Now think a little bit more about connected TV for a moment. Connected TV is nice because you're not facing the antitrust competition that maybe Google or Facebook are experiencing. Connected TV is actually driven by a new form of cookie, and this new form of cookie is called UID2. Now, what's brilliant about UID2 is it was actually created by Trade Desk. And I want to be clear, okay? Maybe I'm slightly biased. I'm an investor in Trade Desk, okay? But I want to explain why. People always ask me why, and why aren't you investing in Netflix or Disney or Roku? Here's why. UID2 was created by Trade Desk, but they purposefully made it open source, in my opinion, because they're playing 4D chess with the regulators. They don't want the Google problems, where people, we've got these antitrust concerns for Google leading to a disaster with potential Google advertising and their basic advertising monopoly, right? And that's because they have like 90% sell side control of the inventory for advertising. But UID2 is basically different from third-party cookies, but it's somewhat similar in that basically users provide consent to a publisher by sharing their email address, and then a unique ID is created with that email address. Google has one that uses that's sort of a new cookie that uses your phone number or your login ID when you're logged in with Google to kind of track you around. But with UID2, it's sort of the competitor to Google's versions. UID2, you're using email addresses to create unique and encrypted IDs to make sure that your data remains private, but as long as Trade Desk or some of these connected TV platforms can capture about 10 to 15% of users, they can anonymously model data much better than the old cookie system. And they're starting to use AI to help model the data and make sure that people are placing their ads with the highest ROI. And that's where you're seeing declines in linear TV advertising. There's no doubt that linear TV is going over to connected TV. Then it's just a matter of who's winning. And Trade Desk so far is one of the big winners. They have something called the Koa AI. You could learn more about that, but basically it's really good at using AI to find your best customers via lookalike modeling and trying to take the data that they do capture. They use UID2 to do this. They learn a lot more with UID2. The estimates are that the Trade Desk framework could basically increase ROI or CPMs by about 116% compared to some of the older forms of cookies. And really, the fact that UID2 is open source and is essentially a self-regulated platform limits you from antitrust complaints. You know, a lot of other people are like, Kevin, why aren't you investing in Google? It's like, well, you're investing in Google for advertising, but advertising is plummeting at Google. You could try to go for the hype of, oh, well, it's sold off, maybe buy the dip on Google because they do have AI. But, you know, other companies have AI too and are actually making money and are growing. And this to me is hands down Trade Desk. So look, yeah, am I biased because I'm an investor in it? Of course. But I'm also defending my position as to why I invest in Trade Desk. Now, I'll give you a quick valuation on Trade Desk. Just really, we'll do a quick little PEG ratio here, and then I've got to go to the course member live stream. I'm trying to get that course member live stream started a little bit earlier, regularly here, but I keep talking too much on this stream. So we are looking for the end of 2023 to be looking at about a $1 EPS, which does mean that it's about $1.05, which does mean that right now at 55 bucks, Trade Desk is trading a little rich at 52.3 times. They are expected to grow at about 30 to 35%. Let's go conservative and take 52 divided by 30. It puts you at about a 1.73 times PEG ratio for Trade Desk. But that's my thesis on Trade Desk. A lot of people have been asking about it, and I figured I'd add some of my opinion on that. So, but yeah, otherwise, I'm not a big fan of the advertising space. This is really the only player I find interesting. And there you have it. Thank you so much for watching. Appreciate you coming to another Meet Kevin report. Hopping straight over to the course member live stream now. Thanks so much. Goodbye.